Hello, thank you, and welcome to this Campus Capital webinar, part of our virtual education series. I'm Samantha Deakin-Hill, and today we're going to be talking about first investor founder meetings. What are they? What do we hope to get out of them? And how should we conduct ourselves as investors meeting with founders? To help us pick apart this topic, I'm joined by Rupert Wingate-Saul, Investment Director at AXM Venture Capital. So Rupert, thank you for joining us.
No problem.
So for everybody who hasn't joined us before on a Campus Capital webinar, feel free to drop questions in the side. I have a few questions of my own, but we'll take questions as we go along, and then we'll do more questions at the end as well. We should be here for about half an hour or so, give or take. So just to kind of jump straight in, Rupert, you've been known to say that the first investor founder meeting is a two-way street. What do you mean by this?
Okay, so from an investor's perspective, it's very easy to see that the first meeting is a chance to really evaluate the management team, get under the skin of the business, really get a feel as to whether this is a business you want to invest in and a deal you want to do. I think it's very easy to underestimate the extent to which management are also evaluating the investor and deciding, is this someone that we want to partner with, and is this someone we want to go on a journey with for 3, 5, maybe 7 years? So I've been called out by one founder in the past. I actually subsequently made an investment in him, but we were chatting 18 months after I'd invested, and he said when he originally pitched to me, he noticed I was on my phone, I was distracted. He didn't feel that he was getting my full attention. I was thinking back to then, well, what the time of year it was, and I think we're in the middle of trying to close a deal at that point. I'm sort of waiting for feedback on the documents. So clearly, from my perspective, that first initial meeting was maybe a little bit of a lower priority. But from his perspective, it clearly wasn't. He was going looking for money, and this was a big meeting for him. And it was something that stuck in his mind for 18 months. So really, you need to do either one of two things. If you know you're in that situation, either be very honest and postpone and say to the founder, can we do it another time? Or actually give a short and defined time frame for the meeting and say, look, can we do this in an hour, but make sure you leave all the other considerations and thoughts at the door, and you're really focused for that hour on actually the business and them and giving them your full attention. So beyond simply being rude, it does actually have a very material impact on the quality of your deal flow, because yes, you'll turn down a lot of the pitches you see, you won't make a lot of you'll probably maybe only make somewhere between 1 and 5% as a ratio between businesses that you look at and businesses that you invest in. But the ones that you do want to make are likely to be competitive, so you will be up against other people. And you don't want to make it harder for yourself by having a founder who thinks you don't care or you don't understand the business, or he's a low priority for you.
And that's something that we don't see come across very much on shows like Dragon's Den, for example, where it's very much just the company pitching to investors and just really hoping that they get the money. And you don't necessarily see the negotiation that happens afterwards and all of that kind of thing. And it can lead us to kind of assume that, the investor holds all the power, right?
I mean, I hate Dragon's Den as a program. I will not watch it because it is so unrepresentative of the reality of what that relationship should be. The way a lot of those investors behave on the show, if someone walked into a pitch and the investor acted like that, then the entrepreneur would be quite within their rights to walk out and say, I don't want your money, I don't want to partner with you, I don't want you buying into my business. I think what simply doesn't get kind of reflected in those shows is the fact it is only the start of a long relationship, up to 7 years, 10 years in some instances, and you've got to be able to work with the person. And if at that first meeting they're acting like that, it's unlikely they're going to get better as you go through the relationship, and you'll probably have personality clashes further down the line.
And so I guess One of the things to bear in mind, though, is that there is an element of analysis going on, right? So when you are an investor in that situation, so there's analysis happening on both sides, and there's assessment happening on both sides. But I think for our student VCs, as for a lot of VCs, this is the kind of the second or third stage in the pipeline, right? This is, they've received a pitch deck, they've had a look at that pitch deck, and now they've made a decision somehow to take this first investment meeting. So, I mean, in that situation, there's obviously some information as the investor that you are wanting to get out of that meeting. What do you prioritize? What do you really have to have got out of that meeting in that 1 hour so that you don't leave feeling like it's been wasted time?
So you'll obviously want to go through, if you like, all the tick boxes to make sure that you have got the points about the business. So you'll check out the management, you'll check out the market, you'll check out the traction, the stage of development of the business. You'll ask them about the competition. You may ask a little bit about the exit. But to be honest, a lot of that you can either probably get initially from the pitch deck before you meet them, or you can go back and kind of follow up on afterwards to confirm your understanding. There's two really crucial bits I think you need to get from the meeting itself. And the first is actually a view on management, and that's a view on management when they're sitting in front of you. So,
and this is the team, right? That's what you mean by management.
So yeah, senior team, founders, typically founders or co-founders for the business. Mm-hmm. So the first question really is can someone on the management team really sell? So one way of looking at the development, particularly of early stage companies, is that they will be constantly selling, whether that is to co-founders, kind of early hires, senior recruits. It'll be about selling the vision. Obviously, they'll be selling to customers as they go along. So can they articulate the vision? Can they articulate the pain point? Can they articulate the value proposition? And then by the time they come to you, it'll also be, can they sell to investors? But can they sell to some of the maybe later stage investors further down the line who are going to put big checks into the business at the point that they really want to accelerate and ramp up their growth? And so that process is constantly about a vision, a proposition for the business. And if they can't articulate that to you in that meeting, then chances are they're going to struggle to articulate it to all those other components that I've described. And actually, that's going to be a real blocker to them scaling the business. And you don't really get that sense from a pitch deck. You often don't get that sense until the person or people are actually sitting in front of you and talking and describing, and you can get a handle on are they passionate about it? Are they knowledgeable? Are they credible, ultimately? The second bit to test, and this may sound slightly bizarre, is just being really comfortable that you understand what the business does, because that isn't always brilliantly articulated in the pitch deck that they put over.
And not being scared of like looking stupid, right? By saying, what?
Yeah, absolutely. It's both sides. I mean, you have to be really kind of willing to just repeatedly ask. If you're not clear on a point, or you feel that they're fluffing a point, just carry on asking about that point until you're comfortable that actually either you have a proper understanding of it or they don't have a proper answer to the point. I mean, the good test is, can you, when you walk out the meeting and someone says, oh, who was that company and what do they do? Can you firstly actually play back to them the proposition, what they do, what the business is? And then when they say the question, oh, that's a bit like so-and-so, can you articulate the difference, why they're different from the big player that whoever you're talking to has heard of, what the special thing is that they do that actually makes it a potentially exciting investment and not just a kind of a Me Too play in a market that's already there and already exists.
I guess, you know, based on going back to your first point as well, and when you take those two together, there's the risk that the founder is so good at selling that you don't step back and look at, you know, rationally, you know, have I just been sold to, or, you know, do I actually fully understand this, or am I just caught up in the, you know, in the sales pitch and the enthusiasm of the founder? Yeah,
so you certainly have to apply a degree of kind of healthy skepticism, and,
right.
and do try and get through the level of kind of just buzzwords. So if you're asking them what do they do, and their response is, we have a disruptive AI blockchain fintech solution, we're going to have a paradigm shift in multi-billion-dollar markets, and we're going to have a billion-dollar exit within 5 years. And
you say, awesome, we'll give you 250K right now.
Yeah. The correct response is, so what do you actually do? So you have to kind of often drill down into that. But then do consider, if you've got this brilliant salesperson in front of you and you really buy into them, you think, yeah, I'd buy that. Okay, it's not kind of cut and dry that this will be a good investment, a good bet, but they're likely to have that effect on other people. They're likely to be able to inspire. They're likely to be able to lead. They're likely to be able to build a team which is maybe over and above where the current stage of the business would justify. So that's a positive asset. Don't be just skeptical of this kind of salesy founder. It actually could be a sign that the business will do some kind of really interesting and unusual things.
Okay, and then did you say there were 3 points? 3 pieces of information you wanted to take away? I've been interrupting you.
No, I'm sticking on 2.
2. I must have misheard that. That was so. I mean, when you're getting all of this information out of founders, I think there's a risk that it can feel very much like an interrogation. From the founder's perspective, quite uncomfortable, but also, from the investor's perspective as well. And I just wondered, in the many investment meetings that you have now had, do they tend to feel more like conversations, or do they feel more like interviews?
That was very much aimed for a conversation. I mean, the thing I hate is, and try and get all the meetings away from, is a pitch. As an investor, again, it may sound bizarre, but I do not want to be pitched to, because a pitch is kind of the polished, best presentation of the company, and one, it's probably not actually the interesting bits the investor is looking for, and 2, it's not actually really helping you get under the skin of what the founder is like.
Because it's rehearsed.
On their journey going through building the company, it won't be polished and it won't be the best presentation. It will be things going wrong. It will be unexpected things happening. It will be people who they kind of struggle to interact with them, asking them silly questions. So actually, you're far better trying to set it up as a conversation where you're pushing them to talk as much as possible. There's a good reason in terms of finding out information about that, and you're steering them towards the various points that you want to touch on, rather than just firing kind of pre-prepared non sequiturs at them, because it probably won't tell you as much as you want to know, and it'll kind of put them off their game, possibly unfairly, if they're just having to effectively answer a cheat sheet of questions that you prepared in advance. That said, you are trying to pull out probably a number of things from your conversation, and some of them can be a little bit uncomfortable at times. So I always think you should, on certain points, challenge the founders in an early meeting. You want to see how they react when someone pushes back on them, or someone says, well, I don't think that's logical, or that contradicts previous experience that I've seen from another company. It's always good to see their adaptability to explain a concept if you don't necessarily understand it. I come across a lot of founders who will come out of a sales meeting and say, well, we pitched it and they just didn't understand. They were stupid. They didn't have the kind of brains to actually get what we were pitching. Well, that's probably a problem on the company selling the product, not the people being pitched to. And also, as wrapped up in all of that, you want to kind of understand the extent that they will be open to debate and challenge, or whether when you do push back or suggest something different, they close off and just want to go down their route or their pre-prepared answer. And pulling those elements together in a conversation will tell you a lot about them, and they'll give away a lot more than they realise just by talking. If you let them talk, they'll often founders typically love to talk about their businesses. It's a huge kind of focus for them. And they'll give away a lot of information just as they take you through the history and take you through what's happening in the business and take you through, oh, this thing's happening at the moment, it's a bit of a problem. And if you learn to just pick up those points and then when something interesting comes up, just kind of push on it, you can actually find out a lot more probably than they realise about the business.
And so it sounds like a bit of a hybrid then, really. I mean, it's kind of, there's elements of an interview, clearly, because there's information that you want to glean, but trying to frame that as a conversational approach. I mean, that's something surely that gets easier and easier with experience, right? And how's your approach changed over the years, do you think? Trying to remember back to, the first few investment meetings that you took on your own as an investor. Do you think that your approach has changed? And can you, remember any specific things that you purposefully did to try and change that approach?
Yes. I mean, certainly to an earlier point, I've become far more likely to drill down on the same points until you're satisfied you have an answer that actually you're happy with.
Because that's awkward, right?
Yeah, I mean it is when you say something and they give you a response and you ask again and they don't give a response. I mean, and then you sort of ask the same question a third time. I mean, you're kind of getting the point of concluding either you're an idiot or they can't communicate their point. So it is uncomfortable being in that meeting, but equally. You gain some kind of really important insight into the business and the founder at that point. Also, there are other stylistic things. You get a lot better at just being kind of easy and natural and having a way of bringing them into the meeting, sitting them down, getting them a coffee, starting the conversation. Opening question that I always use is just ask them to kind of give a bit of their background and sort of how did we get here type question. Because that'll set them off. It'll set them off on something which isn't challenging. It doesn't set them straight into a pitch of the product. It's a far more kind of easy and natural entry point into the conversation. And you've started them talking, and you can start steering from there rather than giving this kind of cold opening that may intimidate them or put them on their guard. And I mean, the most powerful thing actually from an investor's perspective, going back to your sell to the company, is you just get a lot more experience and you can reference a lot more points and things that you're familiar with, which may or may not be useful to them, but at least opens up an interesting debate or discussion in the meeting itself. So that will very much help to build your credibility because you can show them that you hopefully know what you're talking about. And back to the point of being a credible funding partner, you would be someone they want to work with, even if you don't necessarily understand the business in the depth that they do now. You know adjacent markets, you're kind of familiar with some of the challenges that they face, and given time, you would actually be someone who could usefully add to the growth of the business.
And that experience is really something you can only get from just repeatedly having these kinds of conversations, right? As companies get better at articulating their business, the more often they articulate their business, investors get better at understanding which questions to ask and, how to be more comfortable, I guess, in these situations.
Yeah, the experience is very much, you just have to do it. And actually a lot more of it comes with working with the portfolio post-investment than it comes to taking a lot of meetings, because it's that not quite operational, but seeing the more month-to-month challenges that the companies have, which actually then builds the credibility when you're talking to a new prospect. So yeah, I mean, you can cheat to a certain extent if you're going into a business or a discussion with a business that you know nothing about and you have nothing to fall back on. Ring someone else up, find someone who does understand a little bit about the sector, ring them up, take 10 minutes of their time and just say, look, what would you ask these guys? And then, okay, it's not direct experience and you maybe have to be careful how you couch it, but at least you're asking questions from a kind of a relatively knowledgeable standpoint rather than having to try and make something up on the fly in a sector that you know very little about.
Yeah, I mean that doesn't sound a lot to me like cheating. I mean, there's no exam taking place here, right? And I can definitely think of at least one occasion where that's happened with one of our student VC teams, where we had a pitch that was very deeply technical and incorporated, a kind of difficult industry with some artificial intelligence, and luckily we had someone in our support network that the student VC could reach out to, and they did exactly that. It was, can you take a look at this, and what should we be looking out for, essentially. That seems like common sense, not cheating.
Yeah, it is. Now, I suppose if I was going to turn that into a cheat, what I'd go in and say to the company is saying, well, I'd tell them who I rang up. So say, so-and-so is in our network. I had a conversation with them before this meeting. I'm going to replay to you some of the questions that they have. But equally, if you'd like to have a chat with them after the meeting, whether or not we take this forward, very happy to introduce you. So you're using that individual and that kind of contact as a chip that you're throwing in as you try and build the credibility and sell yourself to the business. Cheating, maybe it's not cheating, but it's maybe it's probably making the most of your network and playing your absolute maximum advantage. But that's what you're trying to do. You need to convince the company they want to work with you and not someone else. So that's an absolute card you can play.
It's adding value again, isn't it, to the founder in the process? Yeah,
absolutely.
Cool. Okay, so I've got a few more questions, but if anybody out there on the live stream has any questions for Rupert, I know you're probably all watching at different times, so we're maybe not in absolutely 100% real time at the moment, but do pop them into the chat box. I am monitoring it, so do send those through, and we'll do our best to answer those in the time that we have left. So Rupert, then I'd just like to know, so we've been talking mostly about the investment meeting itself, right? And we touched on the fact that the first investment meeting is 2 or 3 stages in, right? After sourcing the deal in the first place, or, the deal origination, having maybe a conversation at a networking event, through to then receiving a pitch deck for analysis and going through that. And so I wondered, since we have a little bit of time, what are the things for you that get that founder to a first meeting from that pitch deck? Just 3 or 4 elements. I guess we've referred to these before as non-negotiables in the pitch deck. Like, what are the things that kind of go, okay, yeah, we should take a meeting with this person?
So, I mean, it's difficult to say. I don't think there is, from my perspective, a sort of a checklist of non-negotiables. I think what you're looking for when you're analysing the pitch deck is something that is particularly interesting or particularly catches your attention. So that can be a member of the co-founding team with kind of really interesting previous experience. You may have read the pitch deck and think, I'm not entirely sure about this proposition or how they're setting it up or the route they're taking. But if there's, in the extreme example, if there's someone who used to be head of product at Google, you're going to take that meeting just to see what they're up to and what they're doing. If there's a particularly compelling kind of proposition in there, you feel they've really encapsulated an issue in the market, or if it's an issue that you have some experience of from another company, and you think, oh, that's really interesting. They've positioned that kind of very strongly. Certainly could be, it would be well worth taking a meeting. But it may just be the case that they've either got a non-exec on board or preferably an investor in the business with some really interesting track record. So you take the meeting, again, even if it's a pitch deck that you're not 100% sure on, you take the meeting just to see what was it that this person saw in the business that caused them to put money in or spend time on the business to date. And it is often hard to pull these things out from a pitch deck, because particularly when you've got young, inexperienced founders, on paper their CVs may look either very average, or the company you're looking at is really the only thing they've done. So on paper they don't necessarily look great, and it's not until you actually get them in a room with you and get to talk to them face to face that you understand why they are suitable for the business, or why, say, someone else decided to put money in at an earlier stage. So rather than having a kind of a checklist and they have to get 5 out of 5 for you to take the meeting, I'd always ask the question, is there something in that pitch deck which I really thought, yeah, that's interesting, I'd like to know a little bit more about that, pull on that thread a little bit more, and see what comes out.
Mm. Yeah, I think that's interesting. I think that's one of the first things that we noticed with when we started doing boot camps and having conversations with our student VCs is that sometimes, not all, but a couple of them would have really liked to have just had that kind of matrix, right? You plug in and you ask these questions and you plug in the information, then it spits out the answer of yes, I take this meeting, or no, I don't take this meeting. And it's at that point that you realize that venture capital is really, it's not just a numbers game. There's an element of numbers, but very much a people game. And at the early stages, how much do you think of that is is gut feeling as well?
There's a very significant element, whether it's gut feeling, or it's certainly an element of analysis, which is very difficult to quantify from a deck and a kind of just a series of slides. I mean, the reality of certainly early stage investing is you are not going to get the perfect team with kind of big company experience one side, in the CEO, CTOs kind of done 3 startups, sales officers, chief sales officer of scale, another business, and they've got everything in place. For one thing, if they've already got that team, they'll probably be raising £1 million from someone who's put money into them in the past. And unfortunately, kind of doing early stage seed investing, you're unlikely to get a look in on the deal. So it will be the kind of the bare bones of a team, and a huge part of the challenge and a huge reason for actually bringing the money in is not just because their projections show that they need to ramp up the sales team and the cash will dip and they'll need the funding. It's because they want to probably go out and scale the senior team over and above the current stage of the business. And so that kind of coming back to the point at the top of this conversation, that comes back to, do they understand this requirement to kind of bring in other senior hires and experience and expertise, and do they understand how to set up those relationships and attract those characters, given they won't be able to pay market rate, and they won't be able to give them the 150k salaries that they can earn in their current job in London. And so you're having to bring them in on below market rate salaries, a chunk of equity, and a large portion of kind of excitement and sizzle around the prospects of the business. And it's a question I ask a lot, is what are their, whether you call it a personnel strategy or a talent strategy or whatever it is. And a lot of the startups that I talk to don't really have an answer to that question.
And so is that's kind of a worry for you? Or is it something that you see as, if they're up for taking advice on board, that that can be rectified, or is that kind of a clear worry for you?
Very few of them come in with a kind of well thought through strategy as to how they're going to go out and attract 3 or 4 senior hires. That's probably unrealistic. But it's the ones who are a 2-person team and say, yeah, we've got it sorted. We're just going to be this team all the way through. Yeah. And you're thinking, that's not going to happen.
And no, we don't need an advisory board, thank you. And
yeah, no, we don't need any non-exec. No, we don't want a chairman, anything like that. And at that point, when it's very unusual that they're kind of polished and ready to go and have all these things in place, but at the point where you can clearly see warning signs that actually they just don't want outside influence, outside expertise, outside help, that's a big red flag, and that's the point where you're thinking, actually, I'm going to probably walk away from this investment. Okay.
And so we're coming to the end of our session now, but we have a question from Tom Dwyer. In fact, we've just got 2 questions. So how are you doing for time, Rupert? Can we handle 2 questions? Should we rattle through these? Okay, so the question from Tom Dwyer is, so when on the surface everything looks rosy, what are the aspects you should double check or drill down on, and what are common unforeseen problems?
So the bit to really get your head around is often what is the actual traction or stage of development of the business. So, I mean, sales pipeline. Every business will put forward a sales pipeline. They'll normally show that you've they're selling maybe a few hundred quid a month at the moment, but they're just about to land these big customers who are going to be worth 5, 10, 20 grand a month to them. And actually understanding where they are in that process is hugely important. And one of the advantages you'll have is that you'll probably work with the business for a couple of months through the due diligence process. And it's always something just to keep in your mind as you do the initial meetings, and then you do the negotiation, and then you get into due diligence. What did the sales pipeline actually look like when I sat down with the company, and what does the sales pipeline look like now? And I bet for a large number of companies that sales pipeline stays exactly the same and just pushes out to the right. And what that often tells you is actually this company is at a much earlier stage than they're presenting themselves. They don't necessarily understand their sales cycle to the point that they can close business repeatedly. And that may be things like the product isn't ready for what they want to do, but until they can get some of those aspects fixed, they're not going to scale, and they're not going to ramp up. And money going into the business may not fix those fundamental issues. So that's a big bit to dig into.
Yeah, and that, that's monitoring as you go along as well, and having a good memory or having good audit trail, and
Absolutely. I mean, another bit of what I do is help non-portfolio companies raise money, and one of the companies that we're working with at the moment, that they put in the first investor meeting, they put down a sales pipeline. We came back, met the same investor a month later, and they'd hit the numbers, and that is hugely helpful. And they were some decent. It was a kind of a sexy looking pipeline, and then they delivered on it. And that is hugely helpful and hugely powerful, particularly when you start to sort of negotiate around valuation, and you're trying to say, well, this is a really exciting company, because you can say, look, we said we're going to do this, and we did it. And month on month we're delivering. So these aggressive projections we're putting in, we're going to achieve them. Versus if you're saying, well, we're going to close next month, we're going to close next month, we're going to close next month. In the investor's mind, they'll be kind of downgrading the prospects of that company.
Yeah. And so from Ruman, he says, is there anything, this is an interesting question, just talking about team, is there anything in the attitude of a founder that would instantly make you decide to not invest?
Yes, so kind of amplifying the point earlier, being unwilling to take on external perspective, challenge, advice. I mean, virtually all of these companies say they're going to sort of 10x, 20x their revenues, go from 50k turnover to 10 million turnover. I mean, that is hard. That is unbelievably hard to do, and there are a huge number of pitfalls along the way, and it is unrealistic to expect a founder to navigate those pitfalls without outside help. And if they don't take on outside help, they will fall into some of those traps, and while it may not be terminal for the company, it will simply slow the growth rate down, and it will damage the overall prospects of the company and its overall value. So by being unwilling to take on outside help, they are probably going to have a materially negative impact on the growth prospects of the company, and that's going to affect the value of the investment. So a founder who isn't willing to do that, there's really big question. And Also, they're probably affecting the value of their own equity, given they're typically majority shareholder. So a founder who isn't willing to do that and who will downgrade the value of their own equity simply not to take on outside help and outside influence, there's some really serious questions around whether that's not a problem, but whether that's a suitable venture capital investment.
Okay, so final question then, because we're now at 5:34, and I know you have a dinner to go to. So final question: how would you measure passion, and if it's substantial enough to be effective? So I'm assuming this is the passion of the founder. Do you have anything to say about that? How do you value passion? Because we've not talked about that at all.
So yes and no. I wouldn't be trying to measure passion as in if someone is 6 out of 10 or 7 out of 10 or 8 out of 10 on a passion scale, then either you progress or you don't progress. Ultimately, what you measure a founder on is achievement, and unfortunately, you end up in a lot of kind of debates with founders and teams and kind of members of management around the effort that they're putting in. Unfortunately, in the grand scheme of things, that's irrelevant. It's about output, it's about achievement, it's about results. And so passion, unfortunately, doesn't correlate to output, achievement, and results. So you're trying to grade your founding team more on execution than you are on passion. That said, this is going to be a market that they're going to be in for 10 years if they're going to be successful, 15 years if they're going to take the business kind of to a substantial exit. So there's got to be, there has got to be somewhere in there, and it will be, sorry to jump around a bit, it will be tough. There will be bits where the companies run out of money. I've had companies in the portfolio that are 3 weeks away from having zero cash in the bank. That is a really, while they wait for a sale to come in, or they wait for a debtor to be received, or they wait for another round of investment, that's really tough. So there has to be under there, I think, both an interest in the sector and a real kind of desire to be immersed in that sector for 10 years, and a real desire to drive that business forward and make a success of it. So maybe to contradict slightly what I said earlier, there has to be a hunger. There has to be an interest, and there has to be a hunger to make a success of the business. But you come across individuals who we work with who you sit them down and they come across as just coldly analytical. There seems almost no excitement in the targeting. But my God, some of them are effective at actually executing and just being incredibly precise about how they go and attack their sector, how they are different to someone else, and why people should pay them a lot of money compared to the competition. And ultimately, you take those investments all day long.
Yeah. So passion, not necessarily then one of the absolute guiding measurements that you take.
There's a particular type of entrepreneur who is incredibly passionate and incredibly driven, and they can be a great investment in the right business, the right team, and the right everything else. But equally, you've got the other side of the coin where you're backing the sort of maybe coldly analytical individual, and that doesn't seem to have the same passion, and they can equally work out just as well.
Yeah.
They're very much a single kind of template that you're trying to tick. They're all different components that build up to a picture of the individual or individuals that you're investing in.
I have to say I agree, and Dapo, I hope that answered your question for you about passion. That was the last question that we've got time for today. So thank you, massive thank you to Rupert for his insight. Thank you for joining us this evening, Rupert. And And thank you for joining us at home. And if you enjoyed this session, don't forget to subscribe to the channel, and you can turn on notifications as well by clicking the bell icon next to the subscription button. So until next time, thank you very much for joining us, and we'll see you again soon. Goodbye.